Well, hello everyone, and a warm welcome back to another episode of Causon and the Customer, our weekly podcast discussing all things customer service and effective business leadership, with some of the most knowledgeable on the subject. Last week, I had a fantastic discussion with the Financial Times consumer editor, Claire Barrett, where we discussed the current state of customer service and indeed customer loyalty in the UK. I'm very excited to introduce our guest this week, who has a very different and equally fascinating angle on the value of service to the UK economy. Simon French joins me this week. He is Chief Economist at Panmure Liberum and a regular media commentator on international markets. In fact, I first met Simon when we were guests together on the BBC's Wake Up to Money. I hope you enjoy our conversation as much as I did, and also that it gets you really thinking about the strong link between good service, business performance, and the wider economic state of the UK. So, a very warm welcome this afternoon, and I am absolutely delighted to be joined on today's podcast with Simon French. And Simon, for those of you that may not know him, although I think in the Economist world you're very well known, is Chief Economist at Panmure Liberum, which is a UK investment bank. And I'm particularly excited about having Simon join me today on this podcast because Simon and I met actually a few months ago on Wake Up to Money. And it was very refreshing to be able to hear from an economist who has so much to say about the importance of customer experience and customer service and how that actually has a very intrinsic value to the bottom line of any organisation. So never want to miss an opportunity, because I want to really grab that. I wanted to really have the opportunity to talk to Simon today and understand a little bit more about him, what makes him tick, but also from an economic point of view, how he believes the whole service economy is going, where we're driving, and the importance of it. So, Simon, a very warm welcome to today's podcast, and thank you for being my guest today. Tell us a little bit about you.
Well, Joe, thank you for the invite. That's very, very kind, and delighted to be chatting with you today. So, a bit of my background. So, you've introduced my current role, which is as Chief Economist and Head of Research at Panmure Liberum, which is a UK investment bank seeking to support UK mid-sized companies grow, raise capital, contribute to the UK economy. But my history actually, or my sort of previous career, was as an economic advisor within the UK civil service in the government. And one of the things I really enjoyed about the conversation where we met on BBC Wake Up to Money was I was part of the team that launched the biggest UK staff survey in existence, which is the Civil Service People Survey, where employee engagement was the key metric that we would get out of that. And I really enjoyed pulling together the evidence, as we did at the time, to convince ministers to launch that survey on the link between employee engagement and outcomes, as you mentioned in your intro, the bottom line for businesses, but also for public services.
Absolutely. And, we talk a lot about this, the link between employee engagement, customer satisfaction, and then finally the performance of an organisation, be that either in productivity terms or in terms of financial performance. So, it's a challenging old world at the moment, isn't it, Simon? I mean, there's a lot of things that organisations are facing into, whether that's geopolitical, whether that's economic, the whole kind of aspect around consumer and customer behaviour. And certainly when I talk to our members, some of the things that are keeping them awake at night is how do you navigate through that? So any advice or any views that you would have in terms of really trying to understand the landscape that we're operating in, the importance of the customer experience, and how you keep on proving that financial link between the customer? Because many organisations might see customer service as a cost, whereas, our conversation was very much about seeing it as an investment.
Yeah, so how do I knit this together with my sort of economic view and recent economic events through customer service to the proposition of making really sustainable, successful companies? So I think if anybody listening to this will have lived through the last 2 to 3 years of very high inflation, some of which for businesses most of it for businesses was entirely beyond their control. And they had a judgment to make on how much they were going to absorb versus how much they were going to pass on to the consumer. And that is a debate that all businesses have throughout their life cycle, but becomes particularly acute during a period of inflation, of shocks, where customers are used to a set of pricing, a stability of pricing. And there's a real challenge, which I think any business leader listening to this will have said, is the degree to which we have pricing power, but also want to maintain that relationship with our customer base through this cycle and feel like we are to channel what is a sort of perhaps a politically discredited phrase after the global financial crisis, but in it together. And one of the things we've seen in terms of businesses that have been really successful through this period has been those that have absolutely recognized that it is a partnership with consumers. Consumers and customers couldn't, in many cases, absorb all of the cost inflation of the last few years. So it's had to be shared. And part of the offering is making it absolutely clear that there is a long-term relationship between the company and the customer that means although prices in the short term may be volatile, actually we're giving you a degree of fairness, quality of service that you're prepared to pay for, even when the amount you're prepared to pay for has gone up, if you look at the overall price level, about 20% in the last 3 years.
So would you argue, Simon, that those organisations that, I guess, lent into that issue, outreach to their customers, really understood the pain that they might be in, had a genuine conversation around that? Do you think that's enabled them to fare better or will fare better as we come out of, hopefully, to a period of growth? Do you think that will drive greater commitment, I guess, from customers?
Yeah, I mean, look, let's choose one of perhaps is very close to being the UK's biggest employer, certainly one of its most high-profile companies, Tesco. Now, Tesco went through quite a difficult period, it's fair to say, in the 2010s. Different management strategies. Their key tagline, "Every little helps," was struggling. It expanded into new markets. Perhaps it took its eye off the ball on its core customer and its core customer proposition. But it's fair to say, not just investors looking at this, but the customer base would say that supermarkets, and particularly Tesco, had a particularly good pandemic. It recognised that there were key workers, it was a key service, it was part of the services-based economy that we could still visit in those dark periods of the pandemic, and absolutely recast its customer proposition as being back on the side of the customer. And as it went out of the pandemic, the acute key worker, key service category, and had to make some difficult decisions on price inflation, if you like, it had banked some goodwill from its customer base that could then utilise when inevitably had to pass through some of those costs of foodstuffs and staples, which mercifully are now showing signs. We've had the recent data, the food inflation is down to close to 3%, having peaked at almost 20%. That's a very different environment for retailers. The ones that have done well, and Tesco I'd exemplify as that, had customer service at the heart of their proposition ahead of that really key difficult trading period.
And also, Simon took a long-term approach to that too, which I think is something in the UK we're very short-term, whereas what we can see is those organisations that have a long-term approach towards their customer experience balance all of this. I was with a CEO recently and they were talking about the fact it's not customer experience or customer service in a silo. It's customer service and operational effectiveness. It's customer service and operational effectiveness and investment. That ability to be able to see the customer experience as an integral part of the business strategy. So why is it, when you and I are nodding and we get that, so many organisations still struggle with that, Simon, to really see, I guess, the customer experience as a strategic imperative for that business that's integral and intertwined, I guess, with the other elements of it?
Look, I don't think it's a job that's ever done in terms of sharing the evidence. For some people, and I saw firsthand when I was doing employee engagement surveys, some leaders get it straight away. Some people, the entry point needs to be more qualitative than quantitative. I think the proponents of high quality customer service proposition as core to how you deliver your business recognize that if you look at a management team, a board structure, you can't have a one-size-fits-all approach to communicating, convincing, getting advocates around the board table. Because unfortunately, and I think this is to the heart of the question of why it isn't done universally, when the pressure comes on and different sectors at different times either buffeted by sectoral challenges, personnel challenges, or big macro challenges, the easiest thing, perhaps first order, to cut is some of the stuff that may, in pockets of the board, be seen as non-core to their survival. I get it. I understand it. It doesn't mean that you and I need to agree with it. But if you ask me to diagnose why that happens, I think it's because perhaps there hasn't been enough time taken to advocate in a range of different ways.
So that means that really, quite frankly, those of us in customer experience need to be better, perhaps, in the language and the positioning. And to your point, really understanding the priorities that might be in that boardroom at that given time. And you've got to keep doing it, haven't you? It's not a quick fix. You have to keep bringing that evidence, showcasing examples of organisations that have done that and have really driven that.
So just on that point, Joe, I think maybe we'll come on to this. The UK has, in the recent years, had a particularly poor productivity record. And when you try and decompose why that is, actually, what you find is you have a group of hyper-productive, highly engaged managers and managerial processes at the very top end of the productivity distribution. And then, unfortunately, you have quite a long tail of fairly poor management practices, fairly poor productivity levels. And so actually, sometimes the mystery is not so much that these examples don't exist. I think we can all think of companies that produce great customer service. It's the fact that that dispersion of good practice hasn't been across, well, there's about 2.5, depending on measure, 2.5 to 3 million companies across the UK. There's a long tail of much smaller ones who, although aren't your household names, are really integral to lots of the service-based economy, and making sure that those practices are in keeping with those hyper-productive ones is a really key part of economic policy, which I don't think gets, in my previous career, doesn't get much spoken about at the top of government.
Yeah, I mean, we've talked about the service economy. 80% of our GDP in the UK comes from services. And I don't think that we necessarily understand the critical importance, therefore, of service in terms of delivering that. And to your point, the supply chain, because so very many parts of those organisations that might be delivering aspects of that are delivering the overall supply chain to larger organisations, or to make sure that that whole customer experience, that whole journey from one organisation to the other. Now, you've mentioned quite a bit about management, employee engagement, and I would agree with you, the link is really critical. What are the kind of the skills and the capabilities that you look for in terms of an organisation that is well run, Simon? What are the sorts of things that, if I was putting you on the spot, what would those be?
For me, look, I have a 25-person research department. I'm about to inherit another 25, so I'm about to double the size of our research team. And some management practices are management by numbers and targets and dashboards. For me, if you were to put me on the distribution, what I've found is more effective is on the behavior side of things and the values side of things. And particularly, and the watchword that I come back to again and again in my team meetings is collaboration. And what do I mean? I mean, it's somewhat of a sort of an abstract term unless you unpack it. In my business, in investment banking, actually, you have different functions across the business, from trading through sales, through research, through corporate financing. And collaboration means that when you're serving the end customer, which of course is UK businesses looking to raise capital, if you collaborate as a business, you become that one-stop shop for all the insight and capability that our clients will need. The worst teams, in my view, are quite protectionist of their intellectual property, of their clients. It's quite a closed shop. Now, in the short term, that may be a good survival strategy for you as an individual, as your franchise, but it's not the way, in my considered opinion, on how you build great teams. Because actually, the really great teams actively want to bring people into the conversation and collaborate and leverage their skills rather than close those off. So for me, and I absolutely respect that some people in some circumstances is much more of a quantitative driven managerial process, and that can have a role. I guess my personal management style is much more driven by values, and the key value there being collaboration.
I think that's really interesting, and I would agree, Simon. If I look at, I'm very blessed. I get to work with all sorts of organisations in different industry sectors. But if I look at leadership and I look at, which organisations are doing particularly well, I think they do measure the hard stuff, to your point, because we have to. I think they are consistent in their approach, and they think about measurement from the point of view of what's important to the employee and what's important to the customer. But the point of that collaboration across those silos as well, I mean, you've been very clear about that. It's one, and we have a phrase in the Institute that we call playing for club and country, which is the sense is that you play for your directorate, your club, because that's who you're responsible for. But ultimately, we're playing for the team. We're playing for the whole country. And I think too many organisations, often because of how they're rewarded or how they're set up, play too much for the silo or the club element and not for the overall gain. And if you're a customer or an employee, that's illogical to you, because actually you don't want to be in that stovepipe, do you? You want to be across the whole of the organisation and want to have aspects of all parts of that journey, not just one element. So I think there's something that we really need to change in our psyche around how we view that. So I think that is really interesting. So one of the things that we touched on before we got onto the podcast was, I guess, where are we in the UK? We've talked about the fact that we've been in the doldrums, we've been in and out of a mini recession, but we're just not growing. And you mentioned productivity. One of the things that I know is very dear to your heart is about how we approach risk. As a country, do you think we've become more risk averse? Is that an issue or a challenge for us? And what would you like to do to try and address that?
Joe, look, I'm really pleased you gave me the opportunity to talk about this, because risk can be a dirty word. It can be something to avoid. And I understand why, because in many walks of life, you absolutely do want to minimize risk for obvious reasons, public safety, duty of care. But there are also, any part of a dynamic, productive economy has to be comfortable with a degree of managed risk to try out new processes, new ways of doing things, because productivity, let's not forget, it's one of those words which in an abstract sense might not be particularly meaningful to people. But let's put it into its real nuts and bolts. It's being able to do more with the same, or the same with less. It's being more efficient. And you have to take a degree of risk in order. You have to change your approach of how you go about doing things. You have to recast your proposition. You have to invest in new systems, bring in new people. All of that comes with a financial risk, a reputational risk. Business as usual is the easiest thing to sort of fall back on. But actually, there's quite a lot of evidence. I don't need to go into all of it. The most productive companies, ones that grow the fastest, their profits, their sales, are the ones who are looking at the competitive challenge from within as much as the competitive challenge externally, and are constantly taking risks in terms of, right, is this the best-in-class process of doing it? Do I think, before I come on to how we could solve this or some ideas, do I think we've gone too far towards risk aversion in large parts of corporate UK? I think that's right. And I think to some extent that might be a legacy along the shadow cast by the global financial crisis. But also, there are elements of a very mature economy like the UK with a lot of quite sort of aging infrastructure that doesn't necessarily lend itself to being particularly innovative and starting with a blank sheet of paper or preparing to tear things up. And so, if you like, part of, if you like, addressing this is, as it perhaps always does at some points, coming back to this education piece, not just at school, but education in the workplace, about being comfortable with taking managed risk and recognizing that there has to be a safe space to innovate. Where do managers say, look, I really want to encourage you to come up with potentially 10 ideas on how we improve the customer proposition, even if 9 of them, excuse my French, are BS. Actually, let them come up with the 10th one, because the 10th might be that thing that fundamentally changes the quality of your business. Now, that means inviting risk, reputational risk on the individual to feel confident in a shared forum, coming up with 10 suggestions of which 9 are going to be rubbish. But also the business then being prepared to back things which are changing the proposition for customers, changing their supply chains. I think that managerial class to be able to say, we're okay with that, we encourage that, is a big part of getting growth back into the economy.
I think it's really interesting, Simon, isn't it? Because we've gone through COVID, and I think during that time in COVID, we're probably surviving. We were, focusing on trying to get the stuff out the door, trying to manage things. And I do look at the fact that whether organisations have got a bit stuck in that, a bit comfortable in that kind of mantra, and actually need to step outside of that to challenge themselves, to drive that forward. Again, organisations in my mind are either going forwards or backwards. They're never standing still. So I think, that need to constantly challenge. But one side of risk that I do think is underestimated is the customer risk. And what I mean by that from a reputational point, in the last 12 months, we've seen some pretty awful examples of organisations maybe not thinking hard enough about what the impact has been on that customer or that reputational risk from that. Do you think organisations that you see really understand the importance, I guess, of service from a risk, minimising the customer risk to their organisations? We've seen a massive rise, for example, Simon, in activism. We've seen a massive rise in the voice of the customer. All of that gives us huge data opportunity, but it also increases risk. And do you think that makes organisations more risk averse because of that? Or do you think we are, focusing enough on it?
Probably not. And what I guess when trying to calibrate my answer, the obvious risks that we've spoken about earlier in the podcast is supply chain risk, intangibles, where not just, intangibles and intangibles. So you've got availability of workers during the pandemic because of social distancing, COVID restrictions, etc. You had supply chain risks in terms of product, shipped from overseas, disruption of those supply chains. And did we perhaps, as an economy, take, because we're focusing on the supply side, this is classical economics, isn't it? Focusing on the supply side and not on the demand side, and the demand ultimately being the customer, has the pendulum swung too far towards a board level looking at supply risk, without recognizing the risks on the demand side from an engaged and a well-partnered, a well-supported customer base. I think that makes a lot of sense. I guess the reason why I'm being slightly guarded in my answer is as these supply restrictions, be it numbers of vacancies and therefore labour market constraints and supply chain shipping rates coming down, food prices coming down, availability of goods being pretty back to a level of normality, does that pendulum naturally swing back? Or does it need sort of, if you like, more pump priming? I guess that's where I sort of plead ignorance on the degree to which you get a self-rightening function and focus back towards the customer and the customer proposition, or whether actually that needs proactive action from leaders.
I guess it needs proactive action. And I think if I thought about stuff, and it's interesting, what COVID has done, I think, from a consumer point of view, is we're less likely to buy more stuff. We're much more interested in upcycling, recycling. And that's not just an economic issue. I think that's also been a behaviour change. And we're spending more money on events and perhaps more intangible things than things. I've got enough pairs of shoes, I've got enough items of clothing, certainly as far as my husband's concerned anyway. So that whole kind of thing, but also about, and you mentioned this before, around outreach. If an organisation outreaches to me, emotionally connects to me, engages with me, much more likely to trust that organisation. I'm much more likely to spend more money with that organisation, stay with that organisation, recommend that organisation.
Look, this has been thus far a sort of really very positive and consensus podcast between the two of us. Maybe I'll sort of challenge, not just for the sake of it, but actually because you're asking some of the industry trends I've seen. One of the phrases that pre-pandemic was on the lips of every investor was ESG, environmental, social, and governance concerns. And this comes to the heart of understanding, which is driven very much by the customers being much more conscious of environment, social, and governance issues, and demanding that of the companies for whom they contract with. Have I seen ESG somewhat take a backward seat in recent years because of two globally significant wars and an energy price spike that certainly on the environmental side has meant perhaps a bit more realism rather than idealism in terms of the environmental impact of energy and the energy security, but also broader, societal and governance things have been given perhaps more of a pushback, because whether we like it or not, and I suspect you and I violently dislike these sort of cultural wars, sort of woke, and there has been undoubtedly both sides of the Atlantic a bit of a strong pushback against that, which has a blowback to companies' perceived upside, and I talk about it as perceived upside of being very, very strong on ESG. So I'm slightly, if you like, reporting back what I see on a practical sense of some of the things that were very much driven by customer concerns have been perhaps diluted a little bit in the last couple of years because of global events.
Yeah, and I think that probably is true, Simon. I mean, what you're seeing too, the cost of living and the implications that we've seen across that piece, that certainly the ESG agenda may not be at the front of all customers' minds. However, and I think this is interesting, from our research, what we find is 1 in 3 customers have no longer bought something if the organisation is either not behaving ethically or not behaving, looking after its employees. You mentioned that before. So I think there still is something around, we will vote with our feet if we think that the rhetoric is not matched to the actual activities that are going on in that organisation.
Good, and I'm really pleased to hear that, because, look, you can pull the records. I mean, one of the privileges I have is writing in the Times newspaper every fortnight, and a column I wrote, I think it's coming up to 5 years ago, when ESG was possibly towards its very peak of its evangelical phase, is I did say ESG would need to evolve. It would need to become ESG 2.0, because I thought there was too much, if you excuse the Orwellian reference, 2 legs bad, 4 legs good, in the interpretation of ESG. And actually, if this exercise of exogenous events, wars, energy crises, means that ESG has more nuance, has more of a recognition that these are not binary, these are not black or white issues, but they're quite complex, which ultimately needs to recognize the conflicts that the customer base has. They are cost sensitive, but they're ethics based. It's not one or the other. And see if there's a maturity to that debate that comes out of this, great. And I was advocating for that, as I say, almost 5 years ago. And I'm pleased to see that we are recasting it. I just hope it's recast in a really sensible way.
Yeah, and I think that's, again, fair, Simon, because for me, maybe it's more about the G of the ESG. And I do think that consumers and customers are much more aware of an organisation, how it shows up, whether it does the right thing. And I think that does really worry them. And because we've seen so many high profile, as we were saying before, organisations that have got that so badly wrong, I think that is very much at the forefront of our thinking. And I would say that, wouldn't I? But I think my research demonstrates that. And again, going back to what differentiates a brilliant organisation, what differentiates a leadership that really cares, is, showing up, doing the right thing, being very purpose-led, being very relevant to that audience and making sure that they're really clear about the impact or the legacy. I think my biggest challenge, if I was honest, Simon, which I'd love if I had a pixie dust or a change that I'd like to see in the UK, is we're very short term. The investor community is very short term. Everything is, what's happening in terms of the next 6 weeks in terms of reporting, or 12 weeks in retail, or whatever. How do we, Simon, maybe challenge that a little bit? Because I'm not sure that the continuous short-term approach towards business actually gets the long-term requirements or needs that we could get. So how do we make ourselves less short-term?
In terms of capital allocation, this is not something that, there's lots of stuff that I think regulators and policymakers are blind to. I don't think they are blind to this. Patient capital reviews, the idea that capital is there sustainably offered through the cycle, provides security, stability on which to grow and build, I think is an agenda that successive governments have tried to tackle. The problem is they're sort of walking into a hurricane, if you like, of technology, financial markets technology, looking ever more short-termist in terms of the ability to generate returns, generate alpha, be it high-frequency trading, be it hedge funds as the principal source of liquidity, etc. To steal your phrase from 5 minutes ago, you can't stand still. You're either going forward or you're going backwards. And I think when push comes to shove in terms of capital markets, have we become, as savers, as investors, too comfortable with instantaneous liquidity? But I think it is key, is instantaneous liquidity is maybe hugely attractive for savers who want to be able to, investors who want to be able to turn the sixpence. But there is a blowback, an impact, and I think it is a negative impact, on that stability, that patience of capital, which, if you're trying to grow businesses, if you're trying to make long-term decisions, is very, very difficult. So while I don't think it's particularly popular, what did Oscar Wilde said, everything that is popular is wrong, I think there is a degree of perhaps capital markets going forward need to recognize that perhaps the level of instantaneous liquidity, which is hugely attractive for one constituent, the saver, the investor, may have a negative impact on the ability to grow great businesses.
And I think we see, for me, that's really interesting, because if you look at what we're trying to do, which is have a balanced scorecard or a balanced approach, then that means that we will have to trade some of that. And, if I look at my data, great customer experience does generate those returns, high levels of EBITDA, productivity, all of those things, and revenue, but only if it's sustained over a longer period of time. And that's the really interesting nub for me about how do we try and drive that kind of approach away from being so short term. Maybe it links to your point about risk. I'm more risk averse if I think that actually I need to make sure that I get that return within that particular period of time. So I do think if we can move, if we're thinking about trying to grow to being far more longer term, not in everything, but for some kind of sectors, we really need to think longer term, because that will hopefully give those returns. And I think if we can do anything to adjust that, that would be good. And of course, that also requires government to think about that. It requires the regulators to think about that too. And one of the things I was going to ask you, Simon, is if you had a magic wand, what would you be asking of the next government, whoever that is in terms from a regulatory point of view? What would you like to see a big change? I know that's a big question, but is there anything that you'd like to see?
Well, it is a big question, but I think if we look at the economy, the UK economy as it is constituted today, and this is not a comment that is party political, but over the last 30 to 40 years, so governments of all colours have underinvested in the capital environment, and be that physical capital, roads, railways, buildings, or human capital, skills. We talked a lot in this podcast about management capability. There's clearly an impact of skills development, both at secondary and tertiary, and also acquiring occupation skills in occupation, in work training. I think that's a big focus, or needs to be a big focus, because the famous famous anecdote, you get sort of, two economists, you get three opinions. I think all economists actually agree on this point, that we have underinvested through the cycle. And so what would I like to see from a new government is a focus on, if you like, ring fencing parts of the public purse towards investment. Now, a series of fiscal rules have played around with 3% public sector net investment targets, which I don't think is a bad approach. But I also think there are, back to your previous questions on the ecosystem, the financial markets ecosystem, there are things around, tax relief is offered to savers and investors with the saver and the investor solely in mind, rather than the access of capital to companies. And one of the things that I know the CBI are looking at the moment, I had a very interesting meeting with them the last couple of weeks, is whether that tax element should actually sit with what is in effect a sovereign wealth fund, where it provides that stable funnel of capital that are all of its own. So we get, in effect, units of our retirement savings accrued within an entity, a sovereign wealth fund, that invests in the UK's capital stock. And now, I get it. I speak to investors every day who just say, well, all I want is a bit more Nvidia stock or Apple stock or Amazon stock. I get it. Returns have been much better in US tech than UK infrastructure for many, many years. But there is an impact on the UK economy, the ability of great businesses to grow. And so if I was to look for something that enabled the UK economy to break out of this low growth phase, I think it would be something in that space, a stable cost of capital that allows companies with great customer propositions, great product propositions, to have a more secure pathway of capital.
Yeah, if you think about where we're trying to head, whether that's technology, whether that's the development of AI, whether that's building an infrastructure that enables us to charge our electric cars, whether that is, our infrastructure is creaking. So I think that is really interesting about being able to invest in some of those hardcore things, which will help to jumpstart some of that development. So I think, wouldn't it be great to see a combination? Some investors may be thinking not just about that short-term return, that longer-term return, and then that wider sense of that investing in the growth of UK PLC, really, which is what we're talking about, and making sure we can do that.
And if I can just sort of, if you like, to abuse the position of having the mic and being able to sort of have a second one and bring it a bit more back to sort of customer service, is, look, a lot of the podcasts I listen to at the moment, they start, the middle and the end is all about AI. And because you seem to get credits, don't you, if you talk about AI at the moment, generative AI. I'm a little bit more cynical in terms of, like, mention it if it's relevant, but don't mention it just because it's the buzz phrase. I think in terms of, if you look at and I think we spoke about this on the radio when we first met, is really good adaptation of technology, be it AI or be it machine learning, recognizes the counterparty, the person they're facing off to, the customer experience. And I get that most of the AI use cases are cutting out costly human cost and replace it with, at least at a variable cost or a consistency cost, what is seen as a more stable resourcing in terms of technology. But if we do this really well, if we do implementation, if we do the use cases really well, we don't lose sight. In fact, we put it right at the very center. The principal beneficiary of this has to be the customer who is facing off to that. So AI usage, which is going to revolutionize healthcare, it's going to revolutionize insurance, financial services. Almost no sector will be left untouched. But the ability of that to augment the customer experience rather than leave the customer disenfranchised and felt less powerful rather than more powerful, I think would be a really crucial part of good AI governance.
Yeah, I couldn't agree more. So if you think about this, I remember a very wise person saying to me years ago, you're either serving a customer yourself or you're serving somebody who is serving a customer, because otherwise you're of no use to my business. And I think we have to remember that any technology, any AI is there to give a better experience, a better outcome. And the future world, and we talk a lot about this at the Institute for me, is about a blended approach. And many things which people think are customer service are not customer service, Simon, they're processes. And what I'm really hoping that tech will do is take a lot of that transactional activity that is important because it means that I get something delivered on time in the way that I expect it. Takes that heartache, that pain out of it, but then is augmented by that really special interaction with the human being when it matters, how it matters. And at the moment, I'm not aware of any technology that can really understand where I'm going to go next, really understand that sentiment, that behaviour, and really pick up on all of those emotional cues. It may come. We tend to overestimate, what technology can do for us in the short term and underestimate what it'll do in the longer term. That's for sure. But I think that brilliant blend of having the tech, but also that human intervention and knowing when to deploy it and to deploy it well is what's going to be critical, as well as, which is what you said, designing the journey around the customer. So often we design around what our needs are as organisations. We measure what we need, not what the customer needs, and we don't design around that. And I know you're very passionate about that, Simon. So it's always brilliant to talk to a fellow person that is really interested in that service experience. I'm also really conscious that, can you believe it, we've been rambling on together for over 45 minutes, and I know that we're nearly at the end of our podcast. So can I just say a really big thank you. You've been very generous with your time. One final question I want to ask you is, what is the one change, the one thing, Simon, that you think business leaders can implement today? We've been talking about where the future goes, new governments, all the rest of it, to really change the future of customer service. What would that be?
I'll be really, really practical. Go and see your customers. Go and see them. I say this to my analysts, and sort of equity research analysts are, by sort of their sort of job description, they're quite cerebral folk. They can be a bit sort of into looking at the data, looking at their models, looking at their research product. But actually, I keep saying, look, if you ever have a sort of spare hour, spare period of time where, what shall I do? Shall I write another chapter in my research note, or shall I go and see my customer? And we have a plurality of customers. Sometimes it's the traders. Sometimes it's the company we're representing. Sometimes it's the institutional investor. But go and see them, because you will almost always get a level of insight that just simply is not possible by looking downwards. And I think of my own economics research, I almost always get the best ideas on what to write about. And I've got metrics. I know you're a passionate advocate of let's link those decisions to the metrics. I know that my most read, my most impactful stuff is when I've spoken to a customer, often one of my salespeople, one of my institutional client investors, who says, God, I haven't seen anything interesting about this written. And it's gold dust, isn't it? And if you get that from a customer, God, the quality of your output to the other end, and sometimes it's circuitous, sometimes it's direct, it's so much improved.
And I think, Simon, in a world where tech and data and information is so much more available to us, the ability to look up and look out, I think, has become even more important. And to have that dialogue with your customer and really understand what's keeping them awake at night and really what's driving them will help us far more than any set of analogues of data or other information that we possibly can have. Simon, I think we're going to have to draw our conversation to a close, but it's always an absolute pleasure. I shall look forward to seeing you or being on Wake Up to Money with you again, I'm sure, very soon. But thank you. And thank you also, I think, for really focusing on why the service agenda is so important to the UK and to our economy and that real financial return. So anything that you can do to help the investor community to realise that still further, then we would be very grateful too. Simon, thank you. Thank you for your time today.
My pleasure, Joe. It's been a huge enjoyment talking to you.
Brilliant. Thank you. Well, there you have it. It's always heartening to find an economic expert to discuss how truly important getting service right is to the performance of UK PLC. And join me next time when we'll be moving into the world of financial services, to chat with Alison Rose, who has decades' experience and insight into leading financial institutions. And as always, thank you for listening.